Well, they finally did it 2.5 years into a rate hike cycle, and more than 4 years since the last rate cut. The Federal Reserve lowered its target's interest rate by 50 basis points, otherwise known as 0.5%. The rate cut itself is not really a surprise. The Fed has been signaling for months, as they love to do, that they are going to be cutting rates at this meeting. But there was some intrigue and some mystery heading into this meeting on whether they would cut the rates by 25 basis points, which is kind of the lowest they normally do, or take bolder action by cutting rates by 50 basis points. And that's what they went with, the relatively bolder choice here. But why did they do that? And how quickly will rates fall from here? And what does all this mean for the housing market? Let's jump into it. Let's just talk about what actually happened first. We'll get some context. If you already know all this stuff, I'll go through it pretty quickly, but it's a good refresher. But if you haven't heard this before, it will help you understand sort of the bigger macroeconomic picture. But basically, the Federal Reserve, it's the United States Central Bank. It's often called the Fed, and they control something called the federal funds rate. It's kind of complicated, but it basically sets the baseline for interest rates across the entire economy. Before the pandemic, when it was a quote unquote more normal time, the federal funds rate was at 1.75%. But the Fed raises and lowers their federal funds rate depending on what's going on in the economy. If they want to stimulate the economy and get things moving faster, they lower rates. And that's what they did during the pandemic. At the beginning of COVID, they lowered the federal funds rate to near zero. And that has a stimulating effect on the economy. This obviously happened alongside other very stimulating effects to the economy, most notably the 3 very large stimulus packages that were passed by the government and injected a lot of new money into the economy. And we also had a lot of supply side shortages due to the pandemic. And all those things together led to a ton of inflation. As I said, the Fed lowers rates to stimulate economy, but they also have the job of battling inflation. And the way they battle inflation is by raising rates. So the opposite of stimulating the economy. They did that when inflation got super high, and they raised rates from near zero to 5.25% in a relatively quick period of time. Like, they were very, very aggressive about it. And we've been sitting here for about a year because inflation has been super stubborn, as we all know. And the Fed hasn't felt pressure to lower rates because the labor market has been somewhat resilient. And that's sort of the Fed's job, right? They have to balance stimulating the economy and fighting inflation. And they've been really concentrating on fighting inflation because the labor market has been doing okay until it hasn't been doing okay. The labor market is not in terrible shape just yet, but it's been cooling for a while, and it's sort of cooling more aggressively in recent months. It's important to remember that this is what the Fed wanted. It's not like they're getting caught off guard that the labor market is cooling. They deliberately are trying to cool off the labor market to fight inflation. But they want to just cool the labor market just enough so inflation keeps coming down, but not so much that we go into a big, serious recession. And so they've been saying for literally years that they'd wait until the labor market softened until they would cut rates. Well, the labor market has softened. So the Fed took action and they cut rates by 50 basis points, like we just said. Like I said at the beginning, the interesting thing about what happened is not that they cut rates. We knew that was going to happen. What was interesting is that they're sort of signaling that even the Fed thinks that they may have waited a little bit too long to cut rates because they went with a bigger 50 basis point cut rather than the 25 basis point cut. And so they're signaling maybe they're a little bit behind on, starting to lower rates. That sort of makes sense because history tells us, if you look at historical data, when unemployment rate starts to tick up, even a little bit like it has right now, it tends to accelerate from there. So the unemployment rate, it's only gone up a couple percentage points here, but it could start to go up faster. So the Fed is trying to get ahead of that with its 50 basis point cut, trying to stop it from going up a lot. And so it can hopefully achieve its so-called soft landing. Now, whether or not a soft landing is possible, totally unclear at this time. Some people think that we are definitely heading for a recession. There's been a lot of indicators that point to that. Many people think we're already in a recession, while others say that we're actually going to be just fine. And even though we're probably not likely to see stellar, great growth in 2025 from the economy, that it could still be a pretty average kind of year in 2025 if the Fed is doing everything it says that it's going to do and it works out the way that they're planning. But of course, we don't really know what will happen for sure from here, but we can sort of read the tea leaves a little bit actually and try to understand what happens next. So what we know, and when we're looking forward, we just have to figure out like what we know for sure. And what we know for sure is that the Fed is in the same pickle that they're always in. They're trying to promote economic growth while also trying to prevent inflation. It's this seesaw that they're constantly going back and forth right now. And although they were more worried about inflation for a long time, now they're clearly more worried about economic growth, and so they're cutting rates. But at the same time, if they cut rates too rapidly, they could reignite inflation. The seesaw could tip back in the other direction. And then what would the last 2.5 years of high rates that we've all been going through have been for if they just reignite inflation? So they're trying to balance these things. It's a bit of a dance, and even the Fed doesn't know what they're going to do. They are very, very data driven. They are constantly looking at all sorts of economic indicators, and they're going to wait and look at that data before they make any decisions. But if you do want to forecast, which I certainly do, and I'm guessing you probably do too, we're in luck. The Fed actually puts out something called the Summary of Economic Projections a couple times a year, and it tells us where the Fed members think rates are going to go. And if you look at this chart, you can see it's a survey actually. So it just shows where each individual member of the Fed thinks rates are going to go. And you can see that for 2025, there's actually decent consensus. People generally think that the federal funds rate will fall a bit further to 4.5%. It's worth noting that's not a lot further than they just cut it. So they are projecting slow rate cuts from here. But then into 2026, they're saying it's going to be around 3.5% and go further into 3%. But if you notice, if you look sort of closely at the data here, 2026 and 2027, there's a lot less agreement among the members of the Fed. It's a much bigger spread of where they say it's going to be. And so there's a lot less certainty there. And of course, 4.5% for next year is just their best estimate right now. You have to remember this Summary of Economics Projections, it's always wrong. This isn't, and it's not meant to be right. It's not a plan that they're committing to. It's a survey. They ask each member of the Fed where they expect the federal funds rate to be in the future, and then they just aggregate the results. It's an educated guess. But if you want to know where rates are heading, I think it's the best forecast out there because the people who are making the decisions are telling you what they think they're going to do. So in my opinion, it's better than anything else we got. So hopefully that helps you understand a little bit more about where rates are going by looking at this data. You guys know how much I love data, but before we move on to our last section where I'm going to talk about what this all means for the housing market, I want to just remind you all that if you want to get real estate deals, there's only one data source you need, which is PropStream. PropStream helps investors find motivated sellers in any market across the US with hundreds of different filters. Search both on and off market for properties. You can run comps, get in touch with sellers using built-in marketing tools, and you can analyze deals to your heart's desire. When inventory is tough to come by, like it is right now, PropStream is the key to finding your next property. Check them out at propstream.com/BP. Okay, so for our last discussion point here, what does this all mean for the housing market? Well, I think in the highest level, if you zoom all the way out, it's a good sign for the long run. I think it's a good indicator that affordability, which I've been saying all year is the biggest variable in the housing market right now, could be improving. Just for some context, affordability, which just basically measures how easily the average American can afford the average priced home in the United States, it's near a 40-year low. But mortgage rates are a big component of affordability. So if they come down, that could really help out the housing market in terms of future price growth. But I think even more importantly, it could unlock some supply and it can get transaction volume moving again. Although these rate cuts didn't really move mortgage rates like the day it happened, and I'll explain why in just a second, the anticipation of these rate cuts have helped mortgage rates move down pretty significantly over the last couple months. If you check out this chart, you can see that towards the end of July, they were about 6.8, 6.9% for the average 30-year fixed. Fast forward to today, they're closer to 6.2%. That's, nearly 0.75%. That means hundreds of dollars per month on the average mortgage. So that actually really matters here. The reason that mortgage rates didn't fall when the Fed made this announcement, actually they went up a little bit, is because the Fed does not control mortgage rates. Remember, I said at the top, they control the federal funds rate. And yes, the federal funds rate absolutely impacts mortgage rates, but indirectly. They don't move in lockstep. In fact, mortgage rates are much more closely tied to bond yields, and bond yields have tons of variables that impact them. One of them is definitely the federal funds rate, but other things like recession risk, inflation risk, the performance of other assets like the stock market all influence bond yields and therefore influence mortgage rates. So it's not as clear. It's not, the Fed lowers rates, mortgage rates go down proportionally. That's not how it works. Anticipation of the cut brought rates down this summer, but mortgage rates went up after the Fed announcement, likely because the fear of inflation sort of went up and the risk of recession probably went down. Two things that generally push up bond yields, but that's a whole nother topic. So just as a holistic thing to take away what this means for the housing market, I would say this. The trend is our friend right now, meaning long-term, we're likely to see mortgage rates continue to move down. But I think it's going to be a bumpy ride. We're already seeing mortgage rates tick back up a little bit. They're going to move up and down. There's going to be a lot of volatility. But over the next few years, I do think we'll see rates drop a little bit. I am not personally as bullish as other people saying that we're going to get rates into the low fives by the end of the year. I don't think that's going to happen. I think in 2024, we'll probably stay in the low sixes, close to where we're at right now. It's possible it gets into the high fives, but we're already at 6.17%. So it's not like it's going to move that much in either direction. That is my best guess, but obviously I don't know for sure. But I want to also remind you that even with lower rates, it's unclear what this does for property values. And I know there's a lot of people on social media saying, hey, rates are going down, property values are going to go through the roof. That could happen, but it's not necessarily going to happen. In fact, during most of July, when mortgage rates were coming down, we didn't see any increase in demand. In the last week or so, we have seen mortgage rates start to spike up. So we'll have to wait and see. We just don't know if that's an anomaly or if that's a real trend yet. But it's important to remember that affordability doesn't just impact demand. I think we will probably see some increase in demand over the coming months and in the coming years as rates come down. But it could also increase supply. Higher rates have caused the lock-in effect, which has really stopped people from selling their houses. So if rates start to come down, that could unwind the lock-in effect. That means supply and demand could both start coming back. And if they come back at a proportional rate, supply and demand tells us that we're probably going to get a bit more of the same. So that's my best guess. I think we're going to see more of the same for at least the next few months because we don't really know what the Fed's going to do. I think we'll see some increase in demand, but also some increase in supply. And I think the other variable here is that there's a presidential election and people generally slow down big financial decisions ahead of elections. And so I think we're going to continue to see the solid price appreciation on a year over year basis, somewhere in the 3 to 5% range for the rest of 2024. And then 2025, I think there's a lot to talk about, but I'm not quite ready to make a prediction yet for 2025, but I'll release that in another month or so. So make sure to stay tuned for that. Thank you all so much for watching. I appreciate it. If you have any questions about this, feel free to hit me up on BiggerPockets or on Instagram where I'm at The Data Deli. And don't forget to head to PropStream.com/BP to find motivated sellers nationwide so you can lock down your next real estate deal. Thanks again.